I'm just going to show you my favorite variation of the 3-fund portfolio. A few weeks back, I did a video on the Bogleheads 3-fund portfolio and took a look at how it would have performed if we had invested $1,000 a month in it for the last 30 or 35 years. And in short, it would have done really freaking well, outperforming many more complex portfolios that include 6, 7, 8, 9, 10 funds. Bottom line is the 3-fund portfolio generally outperforms many more complex portfolios, and it does so with much lower fees, and it's much easier to manage and tax loss harvest. Because if you're doing it in a taxable account, tax loss harvesting can add a bit to your returns, and you only need 3 funds to do it with. Or you only have 3 funds to do it with, 3 funds to harvest, and you need 3 funds to replace into. So I'm a big fan of the 3-fund portfolio, but there is one little variation of the 3-fund portfolio that I like to make. So let's just do a quick refresher on the 3-fund portfolio. I've got this example pulled up in front of me. It holds 3 funds to represent 3 asset classes, and those are total US stock market, total international stock market, and total US bond market. So I need to specify, although it is not spelled out here with the initials US, by total stock market, this does mean total US stock market, and by total bond market, this means total US bond market. I've got this example pulled up here just as an example. There's no specific reason why I pulled up this example of asset allocation. So within the 3-fund portfolio, you first need to decide your allocation between stocks and bonds based on your time horizon and risk tolerance for the money. This example here uses an 80-20, but you could do this with 60-40 or 40-60, etc. Right? And then you also need to decide on your allocation between international stocks and US stocks within the portfolio. This example here is using 16% for international, 64% for US. If we adjusted this to 100% equities, it would be about 80%, or not about, but it would be exactly 80% US, 20% international. So this portfolio is really, really tilting towards US stocks. And I think a lot of people, a lot of investors, a lot of bogleheads really have a US stock bias because they have outperformed just so much over the last 10 years. And I've got it all right here. We've got the blue line being US stocks, red line being international stocks, so global stocks excluding US, yellow being emerging markets. And you can clearly see the difference. If you've been in US equities, you really look like a genius. $10,000 invested on a total return basis back in January 2012 would have grown to $40,966 today at a compound annual growth rate of 4.88%. That's fucking huge. That's really good. Whereas if you invested in the global stock market, excluding US, so your international stocks, $10,000 invested on a total return basis. So that means reinvesting all dividends and distributions and capital gains would have grown to only $19,624. So you more than doubled your total return by investing in US stocks only over the last 10 years. And I think this really lends itself to generating the bias towards US stocks. Okay. The other thing we need to consider here is that, and I think a lot of investors really overlook this part, is that at different periods in time, international stocks have outperformed US stocks by quite a bit. So I found this cool little chart right here, which shows the rolling 3-year performance of US stocks versus foreign. And we can see at different time periods, US stocks outperform, foreign stocks outperform, US stocks outperform, foreign stocks outperform. We can see in the 80s, foreign stocks really outperformed US stocks. Through the 90s, US stocks, pretty much took the cake. Through the 2000s, foreign stocks did better than US stocks. And recently, as we know, US stocks are on that really up rip-roaring trend. Okay, so I think the first thing I think is that, a lot of investors should have more allocated to international stocks than they do. I don't want to say they should have more than they have allocated to US stocks, but I think they should have more than they do. And personally, I would like to have more exposure to international stocks. And we're going to take a look at something else. Before we get to that, I also want to make one point, and that is the market cap weighting of US stocks versus international stocks is about 60-40. So the global market cap is about 60% US, 40% international, and that's more heavily weighted towards international stocks, or has more weighting in international stocks than this example here. And again, as I've said many times, than most investors have. The other thing is valuations. With this performance of US stocks and the relative lack of performance from international stocks are at a much lower valuation than US stocks. I found this cool chart right here. Not that one, we already looked at that one. This one that shows the CAPE ratio, the cyclically adjusted price to earnings ratio of the S&P 500 versus emerging markets. And we can see that as of the end of this data in 2019, the S&P 500 had about double, literally double, the cyclically adjusted price to earnings ratio of emerging markets. If we were to extend this forward to 2022, we would see that the CAPE ratio of the S&P 500 has gone up, and probably emerging markets has stayed about the same, and the difference among them has certainly grown. So over the last 3 years, I was going to say February 2022, we're in March 2022. Gosh, we're in the mid to end of March 2022 as of recording this, but in that time period, in that 3-year time period since this has ended, the S&P 500 has continued to gone up. Emerging markets have continued to flounder. So the valuation difference between the two has grown. But it is not always the case that U.S. stocks have a higher valuation, as measured by the CAPE ratio, than emerging markets. We can see back here in 2007, emerging markets actually had a higher CAPE ratio than U.S. And I think that's the real cool thing. There's a lot of diversification value here in holding international stocks, more specifically emerging markets. So you probably know by now my 3-fund portfolio is including emerging markets. You might have that idea, or well, since I just said you probably know by now, I guess I just said it, right? I am a proponent of holding emerging markets in the 3-fund portfolio. Why? And that is because they bring a lot of diversification value in the form of non-correlation to US stocks. Check this out right here, not that, asset class correlations. This data set shows the correlation between asset classes using their representative ETFs. So we've got the iShares Core S&P 500 ETF right here, and then we can see the corresponding ticker symbol. And if we look at it here, so IVV, the S&P 500 by iShares ETF, we can see the correlation to other asset classes. Right here, we've got iShares MSCI EFA, so this is going to be your international markets, broad international markets. They've got a 0.89 correlation. Correlation is measured on a basis of +1 to -1. So these two have a very high correlation. The most uncorrelated equity asset class we can find to the S&P 500 is going to be emerging markets. Emerging markets here over this time period, 2008 to 2022, it's always important to consider that correlation is measured on a time period. So if you change the time period, things would be different. But broadly speaking, there's a broad parameter of stability in saying that the most uncorrelated equity asset class to the S&P 500 is going to be emerging markets. So over this time period, they have a 0.79%, or not percent, 0.79 correlation to the S&P 500. So that is why I would like to hold emerging markets in my 3-fund portfolio in place of international stocks, simply because, number one, international does not provide much or as much diversification value as emerging markets, but also international stocks, and more specifically emerging markets, are at a much lower valuation, and they have much different valuations than the US stock market. So in consideration of that, I want to hold emerging markets in there, but I'm also I'd like to hold a little bit more in emerging markets than I think a lot of people would. And in this case here, in my example, I'm saying 60%, this is an 80-20 portfolio, 60 in US stocks, 20 in emerging markets. So on the basis of my equity exposure, 25% of my equity exposure in emerging markets. I'd feel comfortable going up a little bit higher. I guess I'm being relatively conservative with that exposure to emerging markets. I would personally feel, maybe rather than going 25, maybe up to 35 to emerging markets. Let's just put these into a back tester though and see how this would have done. So what are we going to do here? We'll start off with my portfolio, my 3-fund proposed portfolio, which was 60-20 total bonds. Where's total bonds at? Total US bond market, 20, right there. And we will just change the names to Corey 3 Fund. Just put emerging markets in there. And then we'll do the same thing and just look at 60 US, 60 global excluding US. So this is not emerging market specific, and then 20. And then we will also look at the example that I just happened to pull up here. I did not pick out this example for any specific reason. This is just the first one I opened up. And we'll just do this one, 20% bonds, 64 US, remainder of global. So 16, 20, and I think this one was 54? I can't remember. 64. Duh. Should have done the math on that. And we will set this back as far back as we could go. Now, probably the one with the most exposure to the US stock market is going to have done the best over this time period. Yeah, so it's going back to 1995. Aha! Whew. It did not do the best. This is kind of cool. I like it. I like it when I'm right. The Corey 3 Fund portfolio with emerging markets actually had an annual growth rate of 9.28% over this time period, 1995 to today. So $10,000 invested in each one of these portfolios, invested in my personal favorite, the 3 Fund portfolio with emerging markets, would have grown from $10,000 on a total return basis. So that means reinvesting all dividends and capital gains and or other distributions to a final balance of $111,399 at a compound annual growth rate of 9.28%. Investing in the other portfolio that did not have the emerging markets. So this was, my split 60-20-20, but investing in global excluding the US stock market would have returned 8.76% annually. So $10,000 would have grown into $97,923. And then finally, the other 3 Fund portfolio that I found on the Bogleheads website there, which had 64% US stocks, 16% global excluding the US, and then 20% total bond would have grown to $103,152 at an annual growth rate of 8.97%. So, hey, I always like it when my proposed strategy works out well in a back test, but what I really need to stress here is that I'm not doing this for the back test. I am choosing this. I'm choosing the emerging markets. Why? For diversification value, but 2, also because they have a lower valuation. So there's actually a lot of research out there, and the gentleman's name that researched this is Rob Arnott with Research Affiliates. He publishes a lot of information that shows there is a strong correlation between CAPE ratio and 5-year forward returns, meaning whichever asset class has the lower CAPE ratio usually does better in the future going forward. So I'm making this little twist. I'm making my variant portfolio based on what I think will happen going forward. Now, one other cool thing to do here is change the rebalancing period. This is rebalanced annually, we can see right there. My guess would be that if we rebalance more frequently, my 3 Fund portfolio will improve its outperformance and maintain its outperformance over all of the others. Why? Because there is much more diversification in correlation. Let's just see what happens. I could be wrong on that, but that was 9.28. Was my annual growth rate. We can rebalance quarterly. Hit it. What do we get? And in this case, it did not. So I'm completely wrong on that. It didn't go down much. Went down from 9.28 to 9.09%. Still outperformed the others, but in this case, rebalancing quarterly did not make much of a difference. If I were implementing this I think if I were implementing this in any case, I'd rebalance annually, but specifically in a taxable account, I would definitely rebalance annually so that any of the gains realized from rebalancing are going to be long-term capital gains. So guys, that is my proposed 3 Fund portfolio. That is my favorite variant of the 3 Fund portfolio. What do you guys think about it? Let me know in the comments below. I'm signing off on this one.